Okay, welcome back. Rajesh Bhatia is with us now. Rajesh, good to have you with us here. I don't know if you heard the conversation with the SBI chairman, but what's the thing to do? On the back of this rate cut, what would you buy?
Yeah, I think, the last two interviews were really very informative for your viewers. I think they laid out, Mr. Sethi of SBI just laid out the fact that the growth, which was a challenge, is something that they will address by increasing their loan book. And I think that's great for the stock markets as well. And I think, as Mr. Misty also said, the slowdown that we were witnessing in the last year is also getting addressed. Look, I think the challenge for the market was the slowdown in earnings, which was really by way of slowdown in GDP, because the government expenditure, which was really the one which was driving growth in India, was ebbing because we had to control our fiscal deficit. The other components of GDP were not firing. Fortunately, we have a very good deflationary environment. I would say inflation is very benign across several parameters, and that has given us tremendous monetary policy leverage to jumpstart growth. And I think the RBI governor has been courageous enough to go a 50 basis point plus a CRR cut to jumpstart growth. And when we talk to banks, they say that they are ready to lend again in the retail category. So this is going to accelerate growth, which is great for earnings and great for the stock markets. Left to our own devices, I would not be surprised if India goes to a new high. As far as your sector call is concerned, of course, look, I think the immediate beneficiaries of the interest rate cut are NBFCs. You have seen this is a very strong market. Look at how real estate, capital market plays, engineering companies have bounced back. As an aside, I would say it's probably automobile companies also, which have not participated so far, could also be beneficiaries as you move forward.
So incremental money, when you have to put it to work at this juncture, it would be NBFCs and auto?
So my incremental money has gone into NBFCs. It has gone into auto. It did go into quick commerce companies, and I bought some public sector banks. So that is really where my incremental money has gone. I rue the fact that I have not bought enough real estate or capital marketplace, but I think those are also sectors which can do well as you move forward, given what has happened.
You want to name any names, especially in NBFCs, Rajesh?
You know the challenges that we face, but I have added a gold finance company where a private equity major has taken a stake because it was available at a one-time price to book multiple. So that is something that I've added as far as NBFC is concerned. Of course, we have other NBFCs as well. We continue to like the fast-growing NBFC, which had become extremely expensive, only to become slightly more cheaper over the years as the price consolidated. We think it's catering to the right consumer segment, and it can kind of continue to grow as you move forward. So that's another large holding of NBFC that we have.
Real estate was a missed opportunity in some way. That's what you said. Now, would you look to add to real estate, or it's too late?
So not my money incrementally is not going to real estate. Honestly, like I said, it is a missed opportunity. But when we speak to real estate companies, they are very excited about their pre-sales that they are witnessing. We asked them about whether they are seeing any slowdown given the stock market decline, etc. They were, quite affirmative that they are not seeing any slowdown. So even though they are hearing of an economic slowdown and a stock market slowdown, they are not seeing any pre-sales slowdown. And given this boost that you're going to get from for the economy, I think it's going to be a sector which is going to remain elevated. But for me, my margin of safety is a little low as far as real estate companies are concerned.
Yeah, no, absolutely. The other one is defense sector. By the way, the defense index, we've forgotten about it. It's down. The index is down after a huge amount of outperformance. Do you own anything here, Rajesh?
Yeah.
And the question is it are these buyable now at these levels?
So again, I own only the frontline companies. But I can tell you, we were in a defense conference, and the kind of visibility that these companies are talking about, growth rates, etc., they seem to be full for a 5 or 10 year kind of a period. They kind of are alluding to the fact that they can actually grow for a very long period of time. But I think you've kind of hit the nail on the head. Are these at valuations which are comfortable? But look, I think that's the challenge for our equity market. There's just too much money chasing these growth stories. I mean, look, I mean, I've been to like 5 or 6 conferences in the last month or so. When you talk to electronic manufacturing companies, engineering companies, right, defense companies, the confidence for growth rate for 5 or 10 years is incredibly high. But these stocks are also not cheap. So that's really the challenge that we have. So India is in a very good spot. The risk will be only global. Our macros are very strong, and I think we are again poised to accelerate as we move forward.
No, absolutely. Another sector, Rajesh, like defense, where, I mean, you're asking the question, what's going on with the market caps, which have ballooned, right, is rail. And we're going to focus on that. Nimesh actually is now joining us. Nimesh is going to talk about not rail now, but rail later in about